Hello to all you passive income investors looking for dividend stocks. In this video, I'm going to answer which one I think is the better dividend stock to buy. Is it Verizon or is it AT&T? I'm going to compare these two dividend stocks across several critical financial metrics and come up with a conclusion on which one I think is the better buy. So let's jump right in.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Of course, one of the first things dividend stock investors look at when evaluating dividend stocks is the dividend yield, and in this metric, you can hardly tell them apart. AT&T and Verizon both offer 6.5% dividend yields. Verizon at 6.57, AT&T at 6.54. So you can't tell them apart according to this metric. However, we can tell them apart by looking at some more critical metrics. So one thing I want you to consider is the dividend payout ratio. The dividend payout ratio measures the percentage of earnings per share that's paid out in dividends. It's a measure of how sustainable dividends are. For instance, in this first example here, you have a dividend per share of $1.75 and earnings per share of $2. That means that's a dividend payout ratio of 88%. That's relatively high. That means if earnings per share were to decline below $1.75, that company would be paying more in dividends than it's bringing in earnings. And just like a household that cannot spend more than it brings in earnings for the long term, in the same way, a business cannot pay dividends more than it brings in earnings per share for the long term. Sure, in the short term, it can borrow money to pay the dividend, but eventually it will exhaust its borrowing capacity. Additionally, it can pay dividends out of its savings, but eventually it will run out of savings. That's why in the long term, if you want sustainable dividends, you want a dividend per share that's below earnings per share at a comfortable level, like the second example here, where you had a dividend per share of $2.75 and earnings per share of $10. That's a dividend payout ratio of 27.5%. For passive income investors, what this means is that the dividend is not only sustainable because even a drop in earnings per share of 50% would still mean that the dividend per share is below the earnings per share. But it also suggests that there is room for this company to increase the dividend payment. So investing in this company brings with it the probability that the dividend per share will rise over the next several years. And finally, the last example where we have dividend per share of $3.50 and earnings per share of $1.45, that's a dividend payout ratio of 241%. The dividend payout is more than 2 times the earnings per share. When you see a situation like this, it's likely that this company is going to pause or reduce its dividend payment. That's very likely to happen in the near term unless the company can expand its earnings per share in a relatively short amount of time. So now that you understand the importance of that metric, you can see here the normalized dividend, the normalized earnings per share in the purple here for both Verizon and AT&T, and the dividend per share in the orange. What we're looking for is for the purple to be above the orange, meaning the company is generating more earnings than it's paying in dividends. And we do see that clearly for Verizon. The purple has always been above the orange. With AT&T, it's been a bit more volatile. There's been times when that dividend was over its earnings per share. So if you were to evaluate these two, Verizon has a more sustainable dividend payout ratio. The other thing I want you to understand is the cash flow from operations. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, When you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of percent annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. All right, so now that you've got more understanding about this metric, you can see here that they've gone back and forth in this metric in terms of who has the lead. Verizon in the orange here, AT&T in the purple. You can see Verizon was better in 2016 and again in 2021, but AT&T was better in 2017 and again here in most recent trailing 12-month period. 31% for AT&T, 27.97% in cash flow from operations for Verizon. I will note that these are both really good cash flow from operations to sales numbers. It's just AT&T is slightly better right now in this metric. Considering their forward prospects, you can see for 2024, 25, and 26, Verizon is expected to generate 1.5, 1.4, and 1.7% revenue growth. These are not blistering rates of growth. Earnings per share, meanwhile, expected to decline by 2.8%, then increase by 2.5%, and then increase again by 4.4%. So Verizon's profitability is expected to improve over the next 2 to 3 years. AT&T, meanwhile, is going to experience 1.1% revenue growth in 24, 0.8% in 25, and 1% in 26. Meanwhile, its earnings per share is going to fall by 8% in 24, 4% in 25, and 2.4% in 26. So Verizon has the better earnings forecast profile. Finally, let's compare these two on valuation. AT&T stock is trading at a forward PE of 7.364 and Verizon is trading at a forward PE of 8.564, slightly more expensive than AT&T. Both of these stocks are trading inexpensively. They're cheap stocks, and you can understand why. Their growth rates are minuscule, hardly existent growth for these two companies for the next 2 years and for the next 10 years. Growth is not expected to increase for these two. Additionally, they have a massive debt load, over $100 billion in debt for each of these two companies. So you've got high debt load, slow growth rates. You can understand why investors are not enthusiastic about these two stocks. However, they do offer nice dividend yields for passive income investors. So if I was to pick between these two dividend stocks today, I would pick Verizon Communications. I think it's earned this slight premium over AT&T stock, but they're really close. They're really close. However, if I had to pick one, as a passive income investor, I would choose Verizon. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.